there you have it. Basically, the 10% correction that you called. We're wondering, is that it?
Well, you never know, right? I mean, but we thought it would happen in the third quarter, so it just happened immediately. And there's always different reasons for why it happens. Look, our general take on the correction that we've seen is that we're probably going to be stuck in this range now. I mean, we had a pretty big shock. It wasn't just the correction we saw in the equity markets, but then we had the carry trade kind of unwind. And I don't know how people can sit back and feel comfortable with that. The main thing, though, is what you guys have been talking about this morning, right? The consumer is slowing, right? All the consumer services companies in particular, it's not just the goods companies, and that has to be resolved here. So the way we think about it is, in order for markets to kind of make a new high, I mean, you need multiples to expand, and that's going to be very challenging in a world where growth is slowing, okay? Earnings expectations probably are still too high for the second half of this year, and a Fed that's reluctant to be proactive, okay? And I don't disagree. People are criticizing the Fed. I'm like, well, look, they're just being data dependent. I mean, and so they're doing their job. They're going to react if they need to. If they overreact, then that probably exacerbates the carry trade problem. So they're not going to overreact.
Whether you think you're going to get that 25 or 50 basis point cut over in September, it's still more than a month away. Right. So as rates remain elevated, how much more pain does the consumer see? Do you think investors are perhaps underappreciating how much more pain there's left in the consumer?
Plus they're lags, right? It's not like the Fed cuts at September 18th and the consumer goes to Home Depot and buys a new washing machine on September 19th, right?
Yeah. Well, that's generally been our view, right? I mean, we've been underweight consumer discretionary and sort of overweight the later cycle groups and then defensives on that premise, meaning we think being defensive right here makes a lot of sense for all the reasons you mentioned. All these things work with a big lag, and I completely agree. In fact, our note this week, we discussed this in detail, particularly housing. Right, 25, 50 basis points isn't going to do anything, mainly because most people's mortgage rates are sub 4, if not sub 3%. So you need 200 to 300 basis points of cuts to really get some of these interest rate sensitive areas moving. And that's just going to continue to weigh on consumer sentiment. It's going to weigh on consumer stocks. And so that's how we're set up. We're set up to be sort of underweight that space.